Welcome back, everyone. Next up, we have Trillion Energy. It trades on the OTC Pink sheets under the symbol TCFF and on the CSE under the symbol TCF, and is an oil and gas producing company with multiple assets throughout Turkey and Bulgaria. So attendees, please submit your questions for Trillion Energy through the webinar module right here. And let's welcome its president, Arthur Halleran. Welcome, Art. How are you doing today?
I'm doing very well, thank you, and thanks for allowing me to present here.
Yes, the floor is yours. Take it away.
Okay. So Trillion Energy, first of all, I'm Art Halleran, the CEO of Trillion Energy, and Trillion Energy is a oil and gas producer in Turkey. This picture here is one of our platforms in the Black Sea off Turkey. And as mentioned, we trade on the Canadian Security Exchange under TCF, the Frankfurt, the OTC, and we are ramping up our production now for the gas. Okay, so some background for Trillion Energy to show that we have been around for a while. We are right now currently re-domiciling in British Columbia from the USA, and the vote is on December 17th. Our net income for the last 3 months, ending September 3rd, was about $5.4 million US. Our cash position was about 1.5 million US. And we currently produce about 176 barrels of oil equivalent per day. We have 2 assets right now that are producing in Turkey, and our major asset is it's called SASB, and it's in the Black Sea. It's a gas field, and we own 49% of it. The TPAO, the Turkish Petroleum Company, owns the other 51%. And in 2017, we bought that 49% for about $2.7 million. And the asset's worth about $600 million. And we've produced to date $355 million worth of gas from 4 producing pools. There are some large gas adds. We have 4 discovered that are not produced gas pools. And we also have 6 low-risk development gas pools around the 4 platforms, and we have additional exploration. Before in the Black Sea, there was always a question about if there's enough gas to charge large structures, and the big game changer is that the Turkish government discovered about 19 TCF of gas north of us, about 80 to 100 kilometers, but in the same basin, the same reservoirs and the same source rocks. And this indicates that there is a lot of gas that has been expelled, and it could charge fairly large structures, which I'll get back to this later on. We also have a oil field that is a very stable, low decline producer. And this year will be about $3 million net to Trillion Energy. And we're getting about $80 a barrel. As everybody imagined, it took a bit of a dip there last week, but it's inching back up again. This is the SASB natural gas field in the Black Sea. Here is the large discovery by the Turkish government. And here are our fields. And like I say, we have 4 platforms. We produce 42 BCF, and we have additional wells planned to bring on another 100 BCF. We do have independent reserve evaluations and resource evaluations. And for the 4 pools that were drilled, tested, mapped, but not produced, we have an NPV10, that's our percentage, a 2P of about $76 million US. And with the first couple of activities, we'll be up to 1.8 million cash flow net after all costs. to us. We also have a reserve, and this was done, actually there's an error. This was done, updated October 31st, 2021 for the 6 low risk development, as well as reserves. And the reason for that is because of the new pricing forecast. Our old reserve was based on the end of year last year, and we were in COVID price, and we were at the lowest price we ever gotten, which was about $5.50. Now we're over $10 US at MCF. So the total NPV 10 stands about $170 million US. This is just quickly. So here we have our 4 platforms. We have the subsea gathering system, and we have an onshore facility that's rated for 75 million cubic feet per day. So we have all the infrastructure. All that money's been sunk in, and so we're going to capitalize on this underutilized infrastructure that was paid for before. With the high gas prices now, we always did have a good prices there, and you can see in November 2020 we were down around 5.5, and that was due to COVID. The little blip in 2017, everybody remembers the depressed market, but now we're back up to $10 an MCF. And so when we do our price forecast, we're not saying we're going to get $10. We're being more realistic and say, okay, it's going to settle back down to $9, and that we feel we'll be getting between $8 and $9 an MCF for the next while. And we use that price forecast in our NPV 10 calculations. So capitalize on underutilized paid for infrastructure, capitalize on high gas prices, and also we have the proven non-developed gas pools. So the little green blobs with the red stars are the platforms. Those are the pools that have been discovered, have been produced $355 million worth of gas. And then the yellow stars are the pools that we're going to drill. What we call Program A, and we're going to start that in 2022. And those are very well defined, basically reserves. So an example, I'll just show you here. We'll just look at this well. This pool has been drilled with a vertical well, tested, mapped, everything. Here is, when you drill a hole, they put instruments down the borehole, and it can calculate what's gas bearing. And so for the GLJ reserve report, these 3 zones were tested, and it came back 7.2 million cubic feet per day. There are numerous other zones, about 4 more zones in this well that were not tested, so that cannot be classified as a reserve. But the reserves, like I say, gave us a very high value. What we intend to do is, because it's cheaper and engineering less complicated, is we're going to get a jackup drilling rig. We're going to go to the platforms, the rig hydraulics over the platforms. We will drill from an existing slot in the platform and reach out. So here's the example. Here is the platform, production platform. This is a seismic line, so it's like a section through the stratigraphic sequence. We have very good seismic. They can identify and actually see the gas in the sands. But regardless of that, we have a well that we drilled vertically in the past, 2007, 2004. I showed you the log of it. We know the gas is there. We've tested it, so we can pick the zones. So we'll drill down from the platform, reach out over, and curve to get into the pay. The drilling will take about 30 days. We will then go in and recomplete, and that'll take a few more days. So Not only is it substantially less expensive to do it this way, we also don't have to do subsea completions, subsea pipeline gathering, tie-ins, all that kind of stuff, which takes time and money. We'll actually have gas production within about 45 days of our spud. And then we get our first gas revenue check from that new gas about another 30 days after that. And that's what we intend to do for all the those pools. So that's what we'll do. We'll do program A, which will be about 5 wells and 2 recompletions. And the recompletions will be gas that's still in the well that has not been produced, that's been identified by the third-party engineering report, but we can't produce it because our, say, our production tubing is bent, or we have a little bit of water coming behind the pipe. We have to use a rig to actually go in there and fix that up. And so we'll have 5 wells and 2 recompletions for that. And then we will continue with what we call program B, and that will be the yellow stars. That is additional wells in the pools that we have drilled that have not been produced, but also, so an example would be, you can see this green, this is a pool that has been produced. There's our platform. We map it, everything. We know there's a small little gas barrier. It doesn't allow gas to go through, but there's a 90% chance of this gas being here, but it's not a reserve. These are our low development locations, and we'll be drilling those in 2020, 2022. You don't hear me talk too much about geology. I'm a geologist, but the fact is that we have drilled these wells in 2004, production 2007 to 2011, up until today. It's still producing. So we know these pools from birth to death. It's now just an engineering exercise because we know exactly how they will behave and what the gas will do. This is just an example of the cash flow per month that we'll get. So for program A, we will have, we need a CapEx, our percentage of about $22 million US. What it turns out is for the first 3 activities, basically, we'll be into $1.8 million a month after all costs, cash flow. At the end of program A, will be $3.7 million US. Then we'll go into program B, and we'll be at the top. There will be April 2024, and we'll be up to about 7.6 million US per month, our percentage. Then you'll see this large tail coming off. If we do not pursue any of the stratigraphic exploration, this will tail off, but the fact is there's a lot of other prospects, so we'll flatten that a lot. Just to illustrate that we're a very low gas producer, cost. Here's our price forecast. We say we're going to be between $8.50 to $10 an MCF, and the reason is we're in a production a bubble. 90% of the gas is imported into Turkey. It is a producer's market, so it's basically we have more than one buyer vying for our gas, and the price is fairly high there. Especially when the price in Europe starts to go up, we start getting squeezed. Our benchmark is called BOTAS, and predominantly most of the gas comes from Russia. Our OPEX costs, again, we have a month, we pay $102,000 a month OPEX. So the more gas we produce, the less the OPEX is. So we get down to 11 cents. This is with not including the royalty that we have to exclude. So we basically have op costs below $1.50. So this is the NPV10 value for SASB. And what I want to illustrate is that we have the infrastructure in place that's just waiting. We have a high gas environment that has always been a high gas environment and is projected to be continued that way. And we have these proven gas pools sitting there. And so all we have to do is directionally drill from the platforms and bring that gas on. So if you look at the reserve reports and the resource reports that we have, this illustrates that we are extremely undervalued on the market. So right now, and this changed day by day, we're valued at $32 million US, which is about 17 cents a share. If you look at the first little column here, this is the 2P and medium case for the GLJ reports that we have done in October 31st. And that gives us a value of about $170 million US. This is the most pessimistic case because they actually use low recovery factor, 50, 60, and 70%, whereas we know we have 80% recovery factor because we know a lot about this field. And they also penalize us here 10% because they have to put it in. They say, if you don't get the money, we're going to penalize you because there's a risk 10%. I look at it, if we don't get the money, it's 100%. But if you remove that penalty and you put the proper recovery factor in, we're now $250 million US NPV10. That's our percentage, not 32 million. Now, if you upsize it to the 3P, you're now 288. And again, with the recovery factor and so on, you get up to just short of 400 million US NPV10. If you take that and add now the expiration potential, which I'll show you, we're starting to talk $500 million to $1 billion NPV10 that's on our block within the existing known stratigraphic reservoirs. So the funding for Program A and Program B, we re-domicile the company to Canada, and part of the reason for that was it was going to cost us $400,000 US to do a prospectus in the States. And if we re-domicile into Canada, we can do that for about $40,000, $60,000, and it's 6 weeks. Whereas again, in the States, it was going to be the 4 to 5 months. And in this time of COVID, we have to do things fast because you don't know what's going to happen. Our vote is December 17th. So far, it's looking fairly good. This re-domiciling is pivotal to securing the brokered financing from a Canadian company to fund the development of Program A and the SASB field. We're going to announce this funding, this financing at the conclusion of the shareholders meeting, and the debt financing for Program B. So we're going to use Program A, which will be the key to unlock the SASB. Will have good cash flow. We'll have good news, flares, and that will make, because you saw the cash flow we're going to get per month. We would then want to get 100% debt financing for Program B, and that will make the companies that provide the debt financing more comfortable because they'll see the cash flow we get per month, and they will have a better feeling about it. The upside, this is the expiration. I said that's going to add potentially, make it worth $500 to $1 billion. So I mentioned we have very good seismic. It's 3D seismic. We do what is called AVO, and this is looking on top, and you can see that you get color anomalies that look like rivers, and because they actually are, but they're buried. And we can see sands that are gas saturated, and The only issue is that it's the older technology, so we can't really tell if it's 80% gas saturated or 50% gas saturated. Each well costs about $8.7 million. I can get the seismic redone for about $500,000, which is a good investment. And I'll remove some of that gray area so that our first, and this is exploration, our first 100% stratigraphic type prospect will have a better resolution with the seismic and will mitigate the risk. And here you can see there's the platforms, and these are the stratigraphic prospects that snake off it. Further upside is off the block. So here's our block. There is the big discovery. Here's the Turkish shoreline. This is all owned by the Turkish government. This is open to industry. Here's our SASB. So we have 20 years of data. We have all the seismic. We used to have all this land that we did exploration, and then we drilled some wells and defined our production block right here and let the other land go. We have mapped on here very large structures with good reservoir indications and gas migration pathways. But at that time, the conversation was there wasn't enough gas generated to charge those structures. We now know that's not true. So we need to focus in these times. So the goal is to first get a number of these SASB wells on producing, generate cash flow so that we have our own revenue to do what we want. Then go relook at all the data and the reports we have and the seismics we have, pick the best exploration targets and apply for exploration blocks. And then we put in a bid, and that'll be the future. Those blocks we'll be talking, when I talk about SASB, I talk BCF, billion cubic feet. When I talk the structures off SASB, I'm talking trillion cubic feet of gas. And that's our name, trillion, and our symbol is TCF, which is trillion cubic feet. So to conclude, we have a paid for infrastructure that we got pennies on the dollar. It is in really good condition. It's underutilized. And we're just going to be picking the low, I don't want to say low hanging fruit, but the proven gas, the very low risk gas, so that it'll just be making money. We're going to announce a brokered financing for Program A once we redomicile to Canada, followed by a potential debt financing to execute Program B. The shares are now at 19 cents and 20 cents, so we're extremely undervalued. We have these drill-ready wells which define pools. So some of these pools will have more than one well in it. We have production of 4 million to 7 million cubic feet per day. Our cash flow will be from 1.8 to 7.6 million US dollars after cost, and we have very large future exploration targets. Currently, we have about 185 million shares out. So that's my conversation and my presentation. So there's time for questions.
Thank you, Art. We do have some questions for you and a little bit of time left. Okay. Jose Quintana asks, why is your MC only 35 millions CAN?
Why our value is only 35
CAN, excuse me.
Yeah. So part of that is just the share value that is out there. But a large percentage of our value, which is not reflected on our balance sheet, is actually the asset SASB. And when we took over, when we actually purchased the company in Turkey, there was no reserve reports, and there was no assigned reserves to SASB. And so it was recommended to us for accounting by the accountant and so on that we write off the total asset of SASB because we couldn't carry it if we had no reserves. Well, since then, I have gotten the reserve report done, which took about a year and a half. So we have, as you see, the value for the reserves in there. But I thought what I would like to wait is to have some of these gas wells on production, and then go back to the accountants and so on and see if we can put some of that $300 million value back onto the company books.
Anthony Fitzgerald wants to know, was Trillion a successor to Caspian ONG?
No.
Okay. Joseph Henry wants to know, what are the major catalysts in the next 45 days?
The major catalyst in the next 45 days would be, we have the redomicile vote in December 17th. We then initiate or start the brokered financing in Canada, and we want to actually start marketing probably in the new year, and also sign up the rig contract for the first spud, which there's a delay. So it'll be about 4 to 6 months from once we have the money to when we can actually spud the well.
Great. And Phil M wants to know, can you give updates on new wells or reserves you plan on seeing next year? And what do you personally expect to find?
So the first wells that we'll spud will probably be in the summer. That'll be the actual. So what they did was they went and they drilled a number of wells in the 2011, and then they built the platforms, and the other wells that they couldn't tie in directly to the platform are pools that are defined, they're mapped, like I said, they've been tested, so they're actually reserves. So those are the ones that I'm going to bring on first. So there is absolutely no mystery. So that's where we get about $170 million, or actually for those, we get about a $75 million value. Those wells will test at 4 to 7 million cubic feet per day, but you don't want to bring them on production for that. You'd want to maybe be about 2 to 3 million per well. And out of those first 5 wells and then the 2 recompletions, we will be getting about $3.7 million US a month after cost cash flow. And the reason for that, again, is that we get most of our production from these type of pools in the first couple of years, and that's why they pay out so well. And then right from that, we are then going to go into our development location drilling, which will be 2022 to 2023. And that's where we add the other 9 or so wells of the low risk development locations.
Joseph Harvey asks, how many investors with $1,000 would it take for the first well to come in?
Well, it will be $8.7 million for the first well to drill the first well. So a lot.
You do the math.
Yeah.
J. Kyle Owens asks, what is the status of any current financing?
So we have the one financing, the brokered financing, that is waiting for us to redomicile. And that is one of the conditions that they have. And straight up, they don't want any legends on the shares. So that's the reason, one of the reasons why we're taken out of the US. With the SEC rules, we have that 6-month legend all the time. And if we redomicile in Canada and do it here, we don't have that.
Jose Quintana asks, how much stock versus debt in Program A?
So for Program A, that will be predominantly stock at this time. Yeah. And that's the reason why we need to have the debt component, fairly quick behind it. And I'm looking at $50 million for the debt. And we're in the process. Well, we've already have gone down the avenue for that. And that will bring in a lot of the additional ads and add a lot of value to try to compensate for some of that, that equity.
Beth Heb would like you to expand on this Program 1 financing, both the total amount of funds and is it all equity?
So, right, like Predominantly, it will be all equity. I can't really give out the numbers of what it's going to be and so on, because due to the rules, I have to wait for December 17th to close, and then we will have to do a news release after that, and in that will be the terms and the amount and who it is, right?
Anthony Fitzgerald wants to know, how many fully diluted shares are there with what is currently in place?
Right now, there's 185 million shares out, and fully diluted, we're about probably 195 in that range, because I went and accelerated the warrants in this summer, and that's one of the reasons why we have a fair bit of cash. And I can tell you that in these days, with my experience, I've never experienced such changes due to COVID.
Understand that. Ross Parker wants to know, how do you think your future production margins will be affected by inflation over the next 12 to 24 months?
So Turkey has a very high inflation rate, but how that works is that because it's gas that's brought in, 90% of the gas is brought in from Russia, the price is set every month based on what's called BOTAS, and you can look that up. And so that is set in US dollars. Because we produce in Turkey, it is then converted to Turkish lira. And because the inflation is such that the Turkish lira value decreases from the first of the month to the end of the month. So say we get a price of $10 US, and even though if it stays at $10 US for the full month, we will actually be slowly shaved off. And so we'll go $10, say down to $9.80, $9.75, but then it's corrected. So the price is corrected every month, and we go back to it. So we do lose a little, but internally, inflation in Turkey does not affect our pricing, because we end up getting also paid in US dollars.
Larry McGuire asks, you've been seeking financing in the U.S. and planning to do so in Canada. Can you update us on these plans? And also, how many warrants were exercised over the past quarter?
So I thought the warrants, I forget the exact number, but it was something like 10 or 15 million, I think almost up to 16 million warrants were exercised. And that was the ones that I accelerated for 2020. And the ones for 2021, I have not accelerated those, and those will just go. So could you repeat the first part of the question again?
Yes, you've been seeking financing in the U.S. and are planning to do so in Canada. Update us on those plans.
So we still are seeking financing in the U.S. because we actually have some fairly good debt leads there for large financing. The past financing that we had, that was when we mentioned in May and April, that was like $17.5 million US. And that was like a one-stop shop. And I got kind of memorized or whatever. And it turned out that there was that one piece of paper that they were waiting for that never materialized, even though it doesn't affect our decision. So that's where that one went. But we kept additional avenue or additional paths going that are 100% debt financing and not the 17.5. The equity financing, of course, that's the Canadian part of it. And all the debt financing are looking that we actually bring in some equity component, and predominantly from existing or new shareholders, so that they feel more comfortable. And the $50 million debt financing we're looking at or working on, that's part of the requirement that we actually bring in some equity financing.
Great. Last question, and it's a two-part question from Al Bronson. Has your production and or operation cost increase with this inflation? And how low can oil go after the recent hike before you start to see production costs becoming prohibitive?
Okay, because we're set at $102,000 a month op costs for the SCSP. That is in US dollars, so we're not affected by inflation. We actually, as the lira goes down, we kind of wish that we were tied to it, but we're not. So that is set. For the oil, our break-even price for oil is about $22 US a barrel.
All right. Well, Art, thank you so much for your time and your presentation. We certainly hope that you'll come back and join us in the future with your updates.
With some good news. Okay,
Yes.
thank you. Okay.
Thank you so much. Okay, everyone,
Okay.
stay with us.
Bye.
We're transitioning to our next presenter. We'll be right back.